just moved. So separating myths. So what are we going to talk about today? Dispel some of the investing myths. We will tell the academic story of investing. And I really think there's opportunity to achieve true investment peace of mind for those that this philosophy is adopted by. So what's a myth? A myth is a story made up to explain a phenomenon beyond the science of the day. And so some of the common ones we're going to be talking about: stock selection, otherwise known as stock picking, track record investing, market timing, and the one least talked about, it seems, is the costs of investing. So let's dive right in. We'll start with stock selection. I'm going to start with a slide that basically just defines it: choosing stocks based on a belief that they will do well in the future. The myth is that investment advisors, managers, what have you, can consistently, predictably, and that's the operative phrase, consistently and predictably add value through individual stock selection. The way we're going to make this case initially for the challenge of this is this study that you can see on your screen entitled Survivorship Bias. This is a study that is very comprehensive. It's extraordinarily expensive. It's a $25,000 fee to get this thing. Happily, we did not have to pay for it. But it comes from the University of Chicago. They're Center for Research in Securities Pricing, and they do a lot of really good work with regards to investments, markets, what works, what doesn't, those sorts of things. This database that they've compiled here, what you're looking at is every year going back to 1923, the mutual fund industry. The mutual fund industry employs many of the professional stock selectors, pickers in the world. And so this is just one way to look at this first myth of stock selection. So you see that 1923 was the first mutual fund. And then by the time we get to 2018, there's over 32,000 of them. And just to summarize this, though, funds open as of 2018 was 32,920. Total numbers of funds born, though, during all those years was, as the date this was put together, was 64,000. The chart's a little more updated. There's over 66,000 funds born, which means there's been over 31,000 funds killed during the history of the mutual fund industry. The thing about that that's important for us to know is that when a mutual fund is killed, all of its performance data goes with it. So one of the most frequent ways large fund groups will kill funds is they'll have a fund that's underperforming. They will send a notice to the investors and say that it is being blended into another one of their existing funds. Once they do that, all of the performance history of the fund that was killed has disappeared. It's gone forever. This survivorship bias study is the only place that records what all of that performance actually was and what it actually means when you look at total average mutual fund performance. And the results are pretty interesting. So if you start with this, if you look at the 200 worst of the killed funds, their average cumulative total return was 81.3% down. And as I said, more importantly, that's been scrubbed clear of anyone having to see that ever again. The only ones that do see it is this study that basically goes into the graveyard of those funds and pulls that data back out, which is what we're looking at. If you take a look at this, we're looking at the average U.S. equity mutual fund with all of the data, including the dead funds. This goes back to 1972. And you can see that that's representing a $100,000 investment in 1972. And if you just invested, the top gray line, the crisp market is the global stock market. You can see that money grew robustly. Just behind it, the Standard & Poor's 500, that 100,000 grew to 8.6 million. And then way below the global and the U.S. stock markets is the average U.S. mutual fund with all of the actual data imparted into it. So the question becomes, and it's rhetorical, is in that if all the mutual fund managers could really reliably, predictably pick stocks, why would all those 30-some thousand mutual funds have gone out of business? The answer is clear. It's because stock picking is not reliable, and it's very difficult to do on a regular basis that can be counted upon. And so that's why you see such a disparity. When you look at the average potential wealth loss to active stock management, it's about 4.8 million for every $100,000 invested over this time period. So if we're going to look at investing, one of the ways that people will do that is on the basis of what we're seeing here in myth number 2, track record investing. If we could speak out loud here and say, hey, well, if I'm going to go research something and pick it to invest, what are we going to use as the tool to make the selection? Most usually it's going to be history, performance record, that sort of thing. So what we're going to see is if that's a reliable method. Track record investing is defined as just use of performance history to determine the best investments for the future. The myth being that finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. We'll look at this a couple of different ways. So you're looking at U.S. equity funds. Those are U.S. stocks. You'll see several ways we'll look at this. We'll look at the top 30 on your left-hand side. We'll look at all U.S. equity funds. We'll look at the S&P 500. The CRSP index is the global stock index. And then the number of funds surviving is also just added in. So 20-year period of time, 98 to 2007, you'll see the top 30 funds really killed it in comparison to all of those other metrics that are there, beating almost all of them by nearly 10% at a minimum. If you look then at the following 10 years, we're going to see a different story. But when people were picking on this basis of the top funds in the year 2007, these were the funds that they would have been most likely leaning towards. So if they were to make that transaction, then you go to the year 2008, we look at the next 10 years, you'll see that those top 30 funds trailed all of the other metrics that were indices that were tracking. Did those money managers lose their touch? Did they get stupid? What happened? It's none of those things. It's simply that when active money management happens to hit a market that favors its philosophy, it's going to look good for a period of time. When those market conditions pass, you tend to see happen what we're seeing right here. And that's why it trails. Let's look at this through one other period of time, which would be the 2008 financial crisis. So top 30 funds over the 5 years beginning in 2008, the year the crisis hit. You'll see those returns were much less over those 5 years. Not unexpected, of course, with such steep downturns. Let's look at the following 5 years after this, and you'll see those 30 funds once again trail significantly. And this is absolutely predictable. I've seen studies like this done time and time again over different time periods, and the same thing, same results keep showing up. So what you can take about from this is that a manager's ability to pick stocks in the past has little or no correlation with their ability to do so consistently in the future. And that's the key, consistently in the future. Which moves us on to myth number 3, market timing. This has to do with when do we get in and when do we get out? Market timing defined as any attempt to alter or change a mix of assets based on a prediction or a forecast about the future. And the myth is that managers are able to utilize market timing to effectively predict up and down markets. And the operative word there for me is effectively. Periodically and with luck, sure. Effectively long-term, very challenging, and we'll take a look at that in a couple of ways. This is the first time we're going to see reference to what is on your screen right now. There'll be another time later on, so try to remember this as it comes up again. The Dalbar study. Dalbar is a company that does a lot of research. The study that they're most known for is their quantitative analysis of investor behavior. Very expensive, another very expensive piece of research that's sold. This is some output from it. So from 1985, when they began this survey, up till 2018, what you see is the Standard & Poor's 500 index average annualized return. Those are 500 of the biggest companies in the United States. It's not adjusted for any fees. It's just the true index return. And then you can see below that what the average investor who owned equity funds during this period made during that time. And what you'll see, what you're seeing is their results were substantially less, over 7% less than what the S&P 500 index had done if they had just bought it and went to sleep. They barely beat the inflation rate, as you can see. So we're going to get to some of the primary reasons that this happened, but that is the study, and these results look this way about every time this study comes out. One more pass at this looks at market timing in a different way. We're looking at a 20-year period of time. The market's been open 5,000 days during these 20 years. And so what we're seeing is $10,000 in this case invested. Once again, we're still using the S&P 500. If you look on the left there, if you'd stayed invested all that time, your $10,000 would have grown to over $40,000. And then as we move to our right, we simply see what happens if we miss the best 5 days in the market, miss the best 10 days, and on and on. And as you'll see, when you get down to your right-hand side, if one misses the 30 best days out of 5,000 days, the investor made basically no money. I have shared this with a lot of people in a lot of different ways over a lot of years. One guy who's an old friend from grade school likes to always jab me on this one by saying, "Hey, yeah, I see that you've got the best days pulled out and the effect of that, but what would happen if you missed the worst 30 days?" And the point was being missed in that the key that we're trying to identify here is nobody knows what those days are going to be. We don't know what the worst days are going to be. We don't know what the best days are going to be. What we do know is that markets run in fits and spurts, and that small spurts of time mean a big thing. And we have to be in them to get them reliably. So Charles Ellis, who is on the Yale Investment Committee, pretty much perennially regard their endowment as one of the best run pots of money in the world. They employ quite a bit of the approaches and the philosophies that we're talking about here for about 60% of their portfolio. And what Ellis says is that the evidence on investment managers' success with market timing is impressive, and it's overwhelmingly negative. That's how negative it is. So market timing is a very challenging thing. The very few times we get to see it happen, I'm yet to hear of someone who timed the market really well and really got away with it in a really profitable way. I'm sure it's happened for some of you in your circles, but I haven't seen it, and I have a lot of pictures of it. The fourth myth is costs of investing, and the myth that is here is that these are all the costs, the cost to buy, sell, own stocks or mutual funds. And the myth is what you don't see can't hurt you, and this is something that our industry is woefully behind on, as far as I'm concerned. Starts like this: the bid-ask spread. That's the part of the cost that no one ever talks about. You have to write to get it. It's not going to be, it doesn't have to be quantified, and the fund companies are allowed to make money off it, and I'll explain shortly. And then you have all the other mutual fund expenses, advisory fees, and some of those costs that a lot of people are familiar with. So let's have a look. So let's start with the bid-ask spread. Let's assume I've got young Aiden from our office sitting nearby me, helping me to make sure I stay upright while I'm talking here, and just use him as an example. Let's say Aiden's got a stock that he's going to sell, and he's going to sell it, and he calls his broker, he goes online and he makes the sale, gets to the floor of an exchange, transaction is made, he sells his stock for $49.50 a share. Little does Aiden know that on the other side of that transaction, in my little example of this, I'll use myself. I'm on the other side of the transaction, and I go to buy, just so happens, that same company that day, and I buy his share of stock, except my buy price is $50. What happened to the 50 cents? Well, where the 50 cents goes is to a market maker, which is part of the way the exchange makes money, and they make arrangements with the investment companies as to how much of those spread costs go back to the investment companies. The only way you get this information as to how much trading and cost was generated is through something called the Statement of Additional Information. Nobody ever writes for it. It's in very small print in the back of the prospectus. Now, if Aiden and I were in this unlikely example to meet each other and realize that, hey, I bought your stock, and Aiden says, hey, I sold my stock to you, and I said to Aiden, hey, I kind of like my price. You know, $50 I thought was a good price for that. And Aiden's saying, well, wait a minute. I sold my stock for $49.50. What happened to the difference? Well, now we know this is what happens to the difference in that. So it's a different sell, different buy price. Here's the way this comes out is this adds cost. And what you can see, if you look at the very bottom, the end of this long sentence, the bottom, the smallest stocks average about 33% of 1%, 33 basis points, about 1/3 of a percent for a buy or a sell. That means if it's a round trip where the manager sold some and bought some, that's 66 on that trade. And then the largest stocks get a lot cheaper because there's a lot more liquidity on them. Those are down to 0.04, but once again, you double that for a buy and a sell. What Charles Ellis goes on to say, the man we just quoted, is that it is not uncommon at all for funds to add on an additional 1.6% in fees over and above the stated expense ratio that people read about. And so sometimes when you see some of those commercials from some of the investment companies during football games and weekend sports and other times that talks about no commission, free trades to you, they don't talk about the spread costs on the floor of the exchange. The reason that they can do that is because of this. So these costs are there, they're legitimate, and if your fund has a lot of turnover, that fund will then incur ever higher costs. I think the highest cost I've ever seen out of a fund as we put it through some software that we have was somewhere in the 6% range because of all the trading. So back to Charles Ellis, you know, he just says that under the new rules of the game, and he was just talking about this whole issue of stock trading, he asked the question, how much better an active manager has to be to at least recover the costs of active management? And it's a daunting answer. So the costs of investing are important. And so if you've hung in there so far, what we've got is these various myths of stock selection, track record investing, market timing, and then these various costs. The thing I want to say at this point before we move to the academic approach is that if there were reliable ways to do the things that we're looking at on your screen, if we could pit stocks, buy them, sell them reliably and predictably, if we could get great data that we could really sink our teeth into based on track record investing of such stock selection, and if we could time markets and it could be done reliably, I would be doing it. I'm a capitalist. I'm a capitalist to the core, and I would be doing these things, attempting to make you all more money and for our firm to grow right along with you. So if there was a reliable way, if there was academic research to support it, I'd be doing it. That being said, there isn't. So that's why we use this academic approach. It's worth noting going into this academic approach is favored by many of the largest pension and endowment plans on the planet, and you'll see why. Okay, so now we're getting into what's known as free market portfolio theory. What is it? It's an investment approach that's based on 50 years of sound academic investing research and accepted financial theories. So the components of it are this: free markets work, number one. Number 2, modern portfolio theory. And 3, the three-factor model. We'll unpack these just a bit so you can get your arms around. And then what we'll do is we'll conclude with just a nice example of how this is actually used and the outcomes that are anticipated by actually using these things in a real clear, I think pretty concise way as we'll wrap this up. But I want to make sure you've got some foundations to receive that. So component number 1 is simply this. All these academics lent their very significant brain power to this. Many of these people, Harry Markowitz, for example, have spent their professional lives studying markets, stocks, bonds, what we can expect, what works, what doesn't. By the way, Harry Markowitz just went on the academic board of one of the groups we use significantly, which is Matson Money. And so it's nice to have him there. Merton Miller, also University of Chicago, another Nobel Prize laureate. Rex Sinquefield, he, another University of Chicago guy. He was one of the co-founders of the underlying funds distributed through Matson, which is Dimensional Fund Advisors, one of the leaders in the passive structured fund world. Roger Ibbotson, another one of the Yale guys, has written a lot, professor at Yale, and is part of that investment committee on that great endowment at Yale. Then finally, Gene Fama, University of Chicago, and Ken French lent their work to this. Gene Fama was the most recent Nobel Prize winner out of this group, won it in 2013 for the three-factor model, which we're about to go through in just a moment. So a lot of firepower behind this approach, and everything I say from this point forward really came directly from them, just with me passing it along. So what Fama says about free markets, and boy, the person can get their arm around this, there's some clarity, and I think there's some peace in this. In that in a free market at any point in time, the actual price of a security will be a good estimate of its intrinsic value. What that's basically saying there is, hey, when we look at the price of a security today, with whatever the market's pricing at, he's saying, hey, we can accept that as the price. Instead of some of the other reactions that one would have that would lead them to try to speculate on that by timing it, by trading it, buying, selling it, whatever, based on some kind of a prediction. We just accept what it is, and we let the profits and cash flows of the great companies of the world be the thing that guides our investments upward over time. But one's beliefs about this are going to dictate actions. If one believes that the free markets work, then what we can do is focus on capturing market returns. We've already seen the return of the S&P 500 a couple of different ways. You'll see it again. If you agree those are pretty solid returns, and Fama's big thing is, hey, most funds don't beat it, so why not get it? And so we want to capture market returns. And then there's other indexes around the world that have even done a little bit better than that. We can capture some diversity and some risk reduction in the process. We're going to eliminate then the traditional strategies, which I just talked about, stock selection, timing, and things like that. We're going to use asset class structured or some index funds. We diversify prudently. We can identify risk tolerance with great precision. And then if that's the case, you either do that on your own or with a financial coach who shares your belief and helps you pursue those objectives. That's where we have planted our flag. If you believe that markets fail, then you're gonna follow the alternative, which is you're gonna focus on active management, which is what we just talked about. You're gonna pursue the traditional strategies. You're gonna stay connected to multiple sources of financial information, and you have to read, or someone on your behalf is gonna have to read a lot of market information, and then you're gonna work with people who share that belief. So beliefs truly do dictate action in this. Second component of this is that diversity really works. Harry Markowitz, Sharpe, and Miller contributed to this work. Markowitz's work really has some connection to, why am I forgetting his name? Albert Einstein. Yeah, I'm having a moment here. But it has some connection to Albert Einstein, because here's why. Albert Einstein conceived of the black hole theory on the back of an envelope. It took 40 years for computers to advance and technology to advance to the place that it can be identified. And then Markowitz, in a similar way, came up with modern portfolio theory in the 50s, and technology did not advance so it could be proven until 1990. And so it was a pretty similar story. Here's part of what he figured out. He looked at all the determinants of where we get our returns from. And he looked at all the different ways people attempt to. And if you look on the right side of this pie chart we're going to look at, you'll see a couple of things we just talked about: market timing and stock selection. There's a miscellaneous number of things that are just packed into other. And then the last one is asset allocation, meaning what buckets did you go into? Did you own stocks? Did you own bonds? Did you own foreign stocks? That sort of thing. So here's what his studies found out, is that market timing only contributed 1.8% to an outcome. The miscellaneous factors only 2%. Stock selection 4.6%. So if you add those all up, there's a little more than 8% of the return would be explained by those things. Almost all the outcome comes from just getting money in the right buckets. The other thing that they were able to do is to figure out how to test correlation. You see a really simplified example here: 2 investments, investment A and B on the bottom. They're both going upward over time, but you see as they fluctuate, they don't fluctuate together. And this is the concept of owning different asset categories, so that you're not all in the same thing if and when that asset category has its really bad day. Show you an example of how the last two concepts can be combined to increase returns and reduce volatility. Let's have a look. So we're starting out with our S&P 500 again. You see returns since 1970 are 10.2. The standard deviation is simply a risk, it's a volatility number. You see it's 16.34. All you got to know about that is a bigger number is more volatile, lesser number, less volatile. It's that simple. So let's layer in some other aspects of the market, like foreign stocks. So here you see now we've combined the S&P with stocks from Europe, Asia, and the Far East, otherwise known as the EAFE index. If you look at that, you see since 1970, we lose a little return, not much, down to 9.95, but we also reduce some volatility. Still have all the money in stocks, but we're at down to below 16 on the volatility. Now what we're going to do is add in some international small stocks on top of those other 2 that we had, just 10%, and you'll see that we gain back more return, and we still keep the ending volatility less than where we began. So this is how diversity can increase return and reduce risk. Finally, the 3-factor model. This is where Dr. Fama and Ken French did their work. Dr. Fama is known as the father of modern finance. So it's quite a label that's put on him, but he's done a lot of really good work in this area. Really good teacher I've gotten to sit in front of before. Here's the 3 factors. They seem simple, but when they're put together with a little statistical testing, they come out to something much more. The first factor is the market factor. What market are we going to be in? Are we going to be in stocks, or are we going to be in bonds? Well, when we look at that equation, equities are going to be riskier than fixed income, otherwise known as bonds. And equities historically have provided a higher rate of return, though, in exchange for that risk. So let's have a look. Long-term look, S&P 500 going way back to what we have good data for, which is 1926, almost a 10% return. T-bills are at 3.3%. But when we look at volatility, that standard deviation number, you see a much different picture. S&P 500 was 19.76, T-bills all the way down to 3. So treasury bills have a much lower volatile experience for the owner of them, and accordingly, their return is much lower as well. Stock owners put up with much more volatility, and so they demand a higher rate of return. Thus, you see the higher rate of return in the S&P in exchange for the volatility. The second factor Fama took a hard look at is the size factor. And the question here is, hey, there's other asset categories like small stocks, and you'll see that long-term, they have higher returns than the big stocks, higher returns than the S&P 500. if you've been following along, it won't surprise you that guess what? The volatility on those is higher, almost 30 for those small stocks versus the S&P at 19. Same thing with value stocks. Value stocks, the simplest way to explain those, they're called high book to market value stocks. Another way to think of them is they're stocks that have had bad news. So the stocks are down, they're suppressed at as current time. They can be identified, and they can be identified as a group. When you look at those versus the S&P, they too have a larger long-term return, also more volatility. So what Fama spent all his time on is saying, okay, if we've got these asset categories that have higher long-term returns, but they add some risk, how can we combine them with lower volatility things in small amounts where we can capture some of the benefit of the higher returns they offer while still managing volatility better than just sticking all our money in the US? So we've got some diversity from that. And that's about what we're going to get into here in just a moment. So this academic approach rests on these factors: free markets work, modern portfolio theory, this three-factor model. By the way, the three-factor model, as we stand here today, is progressing pretty swiftly to 5 factors that Fama has been able to identify academically. Still, the 3 is the core of it. So how do we actually do this? So here we're coming down the home stretch. This is how this is actually employed. We've simplified how this is actually employed, but nevertheless, it gives you a good picture of that. So remember I told you to kind of keep a mental file open, if you will, on that Dalbar study, because I've got some of those numbers with one more piece of information back in front of us. On the right-hand side, you see the Dalbar study average equity investors results, which were 3.67. What's been added is the standard deviation that they received, which, as you can see, was 16.76. And if you compare that to the S&P 500 index right below it, you'll see something that this always still really captures my attention, is the S&P 500 standard deviation is only 10 basis points higher than the average equity investor. But look at the results of buying and holding the S&P from 1985 to 2018. They produced a result that was scraping 7% more return. So the average equity investor took all of the risk of the S&P 500, but got a return like a T-bill or not too much above the inflation rate. Why were the returns so low? This is right out of the Dalbar study, and you'll see where the material for this program came from. It came right from this study, because they found that the average holding period was 3.5 years. Why was it so short? Track record investing, chasing the market. Number 3, active stock picking. And 4, market timing. So that's the source of this. Everything we're looking at is from that detailed study. And so that's why we don't practice those things. I'd love to if we could make it work, but that's why. So what do we do about it? So now what we're looking at is we're going to start building a portfolio. We keep starting with our Standard & Poor's 500. It's easy. It's easy to find, a lot of good data on it. And you see its return from 1970 and its standard deviation of 16.3. So what we're going to do is we're going to start doing an exercise to diversify this money. The first thing we're going to do, if you look at your picture on the, I'll go back to the other one, you see all S&P. As I flip, you'll see now we've changed the colors. We've taken some money out of the S&P. We only have 60% left in stocks. And now we've split up 20% into 5-year government bonds and 20% into 1-year fixed income, also known as bonds. And if you look at Portfolio 2's long-term results, we gave up some return to add that much safety. The 10.2 went down to 9, still a really solid return. Look what happened to standard deviation though. We dropped off 40% of the volatility to capture that return, but we're not done. So now what we're going to do is we're going to add in stocks overseas, the EFA index, which is the Europe, Asia, Far East segment, and international small stocks, put 30% of the assets in there. And look what happened to our return in Portfolio 3 up in the upper right-hand corner. Now we've started to climb that return back towards where we started, 9.47. We did add on a little volatility up to 11, to add on those two market segments, but we're still way below where we began with only US stocks. Finally, what we do is we add in small stocks in the United States, both small growth, small value, and large value stocks. And you can see what the final result is. We end up with an outcome that has a return of 10.28, which is higher than what we began. We only have 40%, we only have 60% of the money in stocks, and our volatility is reduced substantially, not quite 40%, a little less than that at this point, but a substantial volatility from 16.3 to 11.6. So this is the work, and basically what Fama, the way he likes to explain this is, if you're going to own a bunch of investments, a certain portion of it should be in equities for future growth to offset inflation and some of those important things like that. Mind you, in the two-person retirement that occurs sometime in the early 60s, the likelihood that one of those people of that one half of that couple, if it is a couple, will hit 90 is getting higher and higher all the time. And every single thing that anyone is going to buy once they stop working is going to at least double in price during that period of time. So we have to have a mechanism to deal with those increases in prices. Equities are one of the ways to attempt to do that. And basically what Fama says is, hey, if you just tilt your mix of investments toward some of these asset categories that tend to be overlooked, the value, the small, both in the US and around the world, we can squeeze out more return. That way we can dedicate some more money to a safety net of some more conservative fixed income, and we can have a pretty nice outcome. The other thing to focus on here, or I want to focus our attention on, one of the reasons why the pension plans gravitate towards this approach so much is that these returns can be statistically tested, and then they can have an outcome that they know with a very high probability. What kind of probabilities? 95 to 97% probabilities of outcomes, a lot like you're looking at here over the time period, which then gives them the certainty, much more confidence that they can pay out what they need to pay out to retirees down the road. And that's one of the reasons why we have clung to it, is because we want to be able to reliably pay out money to all of you in the years that you'll use it for the same exact idea. With that being said, I am thankful that you were able to tune in. Hope you could hang in. I think we got it a little bit under the 45 minutes. If there's more that you want to know about this, more about what we're calling the opportunity, just to have more peace about these things. And so if you want to talk more about that, I'd love to do that. Let us know. We'll set something up. If anyone in your world you think might want to know more about this, we'd love to share it with anybody you want. We're trying to get our philosophies out there. We'd like to help more people, and we're going to work hard to do that, but it starts with doing the absolute best we can with all of you. So I am grateful that you tuned in. I hope you enjoyed this, and we'll look forward to talking down the road.